Are banks in trouble? Interesting. So Marie, everyone's favorite Pennsylvanian Marie, had emailed me a couple weeks ago when her, I think it's Wells Fargo and another bank she deals with up there in PA, got downgraded from, I think it's Moody's or Fitch. Moody's or Fitch, I can't remember. One of the rating agencies. Yeah, my hair's a mess. Sue me, baby, sue me. At least I have hair, all right? All right, still got my hair. Ain't that right, Finney? Yes, sir. And I told Marie, I said, look, man, just being downgraded in of itself. All right, Pablo wants to jump up here. Hold on. I said, being downgraded in of itself doesn't concern me that much, frankly. Okay. I thought you wanted to be on the camera. All right. It didn't concern me that much. No, Finney wants to go outside. All right, come on, let's go. All right, I'm going to take you guys with me. This is what we do here at Heritage Wealth Planning. We take care of our dogs first and foremost. If I wanted a dog channel, I'd subscribe to a dog channel. But Finney wants to go outside. All right, come on, Pablo. Pablo wants to join him because Finney wants to chase ghosts. Yep, there he goes. Come on, Pops. There we go. All right, so we're going to come out here now and sit here next to my grill. Oh, I'm going to smoke some brisket later today. Ooh, I'm getting wet. All right, there we go. Good times. Where do you get that kind of entertainment anyplace else? You don't get it anyplace else, guys. You don't. By the way, you should see I had planted these banana peppers. Man, they are. I'm going to show it to you. I'm going to show them to you. I don't care. People are like, keep to the point, Josh. I don't know if you can be able to see this. Look, I've eaten probably 50 banana peppers off those guys. And I can't, they're just, look at that. Can you see them? Look at those. They're just, oops. Look at them all. I got some jalapenos on. They're too hot for me, jalapenos. Too hot for me, man. Anyway, I got some tomatoes back there. I can make some salsa. Got some peaches, not from my own tree, unfortunately, but some peach salsa. Anyway, all right, so then I get this email from Karen. Check this out. And I forgot what state Karen lives in, or else I'd say everyone's favorite Oklahoman, Karen, but I just can't remember. All right, let's see what she says here. All right, there. Bank of America HELOC. Here's some interesting news that is very telling. This is Bank of America. Remember, Marie had Wells Fargo and some other bank. I forgot what it was, but a local bank, I think. Here is some interesting news that is very telling from Bank of America. They sent us a letter that they're lowering our HELOC. They reduced it by 30%. They said it's due to my property declining. Why they lied? I have no clue. My house has literally gone up 70% since I received the HELOC, and so has the rest of the state, so it's completely unfounded. Anyway, they could have always said we have a policy change and we want to reduce our risks. I think this is something simply dire news on Bank of America's part. Very interesting and scary at the same time. Whoa. All right, so I saw that, and then check this out. Came across this article so I read Anonymous Conservative blog, Anonymous Conservative. You should always check this guy every morning. I do, every single morning. He's a little bit too conspiracy theorist for you. I don't care. I like it. I like people who think outside the box. Anyway, so then I came across, and he has this daily financial trends. Fitch warns may need to downgrade U.S. banks soon. And this is from David Greenberg. And if your last name's Greenberg, you know money. That's just a fact. Greenberg, you know money. So David Greenberg is writing about this. There's something legit here. So anyway, so right here, a new report from CNBC on Tuesday revealed an analyst from Fitch has now warned that if the agency cuts its assessment of the operating environment for the banking industry any further, U.S. banks, including J.P. Morgan, could be downgraded as well. All right. And then if you want to 14 risks you should avoid when you're age 60 with $500,000. They always got a good-looking blonde lady. Always got to have a clickbait there. Isn't that funny? Kind of funny. Here's land.com. Look, I was looking at some properties and some land. I don't have money to pay for any of this stuff, but it's always fun to look at. There's LJ. There's 2 acres in LJ at $30,000. Oh, man, it'd be nice to have that, but I don't have the scratch, dude. I got to pay off my house first. Anyway, the agency already lowered the score of the operating environment of the banking industry in the U.S. from AA to AA minus due to pressure on the nation's credit rating. All right, regulatory framework gaps and uncertainty over the future path the Federal Reserve will take with respect to interest rate hikes. Fitch analyst Chris Wolfe told CNBC that if the agency is forced to lower its operating environment assessment Another notch from AA minus to A plus, and Fitch will be forced to revalidate its ratings for the 70 banks which it reviews. Earlier this month, lenders were shocked when Fitch's peer Moody's released a surprise downgrade of 10 mid-sized banks and warned that several others may see their ratings downgraded as well. So I don't think he's got comments on here, maybe not. Anyway, that's interesting to me. And do you not remember what it was like in 2008? It was actually 2007 and then 8. A lot of people relying on their home equity line of credit to give them liquidity, and it didn't happen. I remember it was yesterday. This is before I even worked at USAA. They were offering 105% loan to value on home equity line of credit. 105%. It was crazy. Anyway, if you took advantage of that and you're max the hill, they reduced your line. They didn't say you have to pay it, but they said, look, you basically have 80% loan to value now. So the value let's just look like this. Say a $300,000 home, and they were giving you that's $315,000 total debt. Total debt. That's a 105% loan to value. The value of home is $300,000. 105% loan is $315,000. All right. It wasn't just USA. It's every bank out there. And you're like, so now you got $315,000 debt on a house that's only worth $300,000 bucks. Now the house drops 20%, so 300 that'd be dropping down to 240. So now you got $315,000 outstanding line of credit. And you got $240,000 out of a home worth. You're way upside down now. And so what USA did and all these other banks, they pulled those line of credits down to basically 80% loan of value. Texas is 70%. Texas, you could never borrow more than 70%. State law. Turned out Texas was smart because they got smoked in the 80s from the oil and gas and real estate. So when that went south, everyone got smoked in Texas. So they said, no more. You can't borrow more than 70% loan of value. Yeah, but long story short, so now you have a house that's worth 240, but you owe 315. And USA's, we're going to cut that line down to 200%, whatever, 80% of 240,000. I don't know. We're going to cut that line down. Now, they didn't call the loan, but they said, you can pay it, but you don't have any access to any more liquidity. I mean, dude, you better get liquid. So I was talking to a guy yesterday, my man Cole, all right, because he likes coal fire warmth. That doesn't make any sense. Coal. What would be a good thing to say about coal? I don't know. Anyway, my man Cole. I was like, dude, so he's 100% stocks. I said, and he's getting ready to retire here in a little bit. He likes the job. Cole's crushing. But I said, man, we need liquidity. We need more liquidity. Need liquidity. And now that we're getting rewarded, I looked at Vanguard money market yesterday, 5.26. I was like, so anyway, think about this. The bank has your mortgage. You're probably paying them 3%. They're turning around and having to give you well over 5% in money market accounts. And I don't know what banks are doing in terms of their certificates. I don't know. I don't know what credit unions. I don't know. But you can get money market accounts at 5.25%. And yet you're only paying 3% to the bank. So let's just say the bank is only giving you 2% on your cash. We'll just use Navy Federal Credit Union for instance. And say they're saying they're giving you 2% of cash. You'd be stupid to keep your money there if you get a freaking 5.25% on federal government loan bonds, short-term, 30-day, 90-day T-bills at Vanguard money market account. You're like, I can get 5.25% on government bonds, which are safer than I could get in a freaking FDIC insured bank account. So now the banks, they're losing money, deposits like crazy. Now they don't need the deposits to loan money out because I might be wrong here, but I don't think so. The reserve requirements are 0%. I mean, literally, they just they click a couple buttons and the cash appears. It's insane. The banks print our money. It's nuts. But at the end of the day, it's like they're not getting any interest income. Remember, so what happens here is because the interest income is 3%. Well, how much does it cost the bank to borrow? The bank's got to borrow money when they go to the Federal Open Reserve, the open window and whatnot. That's the Fed funds rate. So the bank's got to pay to borrow money too. How do they do that when they're only getting 3%? Net interest income. When I was in banking, you take your P&L, your profit and loss statement every month. You have to get your P&Ls because I was a branch manager. You say net interest income by far and away is our biggest earnings. NII. And then you know what the second one was? NSF. So net interest income is by far and away the biggest earnings for a bank, is how much money they're making on their debt and how much they're paying out. And if that net interest income is negative, that bank's it's going to not too long for something has to change drastically. Second biggest profitable thing for a bank, at least when I was in banking, was non-sufficient funds. It's crazy how many NSFs we get paid. It's nuts. And we were a pretty conservative bank, too. We didn't just give checking accounts to anyone who could fog a mirror. But NSFs were a big source of revenue for us, the second largest, for sure. Nothing else came close. NII, NSF. And we might have some revenue from, referring to their brokerage and stuff, but it wasn't much. It's loans. NII, net interest income, is loans. And so we got paid to carry a portfolio of loans. That's how you make money. Now, at the bank, the deposits are a liability. The loans are an asset, if that makes sense. It's kind of weird, man. It's like, wait, so people owe us money, and that's an asset? Yes. But what if they don't pay? Then you'd write off the asset because it's a dead loan. A loan would go bad. Anyway, the point being is this is a very dicey situation. So the banks don't have any money because people are being an idiot to keep it $1 million in a freaking FDIC insured account with, you can only get $250. Who knows what it is anymore? Well, I'm only getting $2. I can go to money market as guaranteed by, well, not guaranteed because the interest rates could change, but the bonds in the money market, if they're federal treasury bonds, they're guaranteed short term. That doesn't mean you're going to get 5% for the rest of your life, but it's like, so the banks, they're losing money. They're going to money market accounts. The money market accounts are paying. The banks still got to borrow money from the Fed open window. They're paying 5. I don't even know what the Fed funds rate is. 5.5, something like that. It's crazy. So the bank's like, I'm only getting 3% on my mortgages because no one's refinancing mortgages. Very few people are buying houses, so I'm not getting much mortgage revenue. So I'm going to have to raise my home equity lines big time, but if I do that, it puts me at more risk because maybe the values of these homes are too high. But for them to tell Karen that their property's gone down in value, it's just a bull-faced lie. It hasn't. Anyway, so what you do? I don't know. I don't have the answers. Liquidity, my friends. Liquidity. If the federal government can't pay its debt on U.S. Treasury bills, it's all done. We're all screwed. It doesn't, literally. It's just that simple. If you think equity in your home equity line of credit, your CD at the bank, your stocks, anything like that is safer and more liquid than short-term government debt, you're crazy. If the U.S. federal government cannot pay its debts on the short-term money, the T-bills that are in a money market account, then it's over. We're all done. But you got to have liquidity. That's just all there is to it. Don't rely solely on your home equity line of credit, and certainly don't rely always just on stock market. Again, just going back to 2008. All right, love your thoughts. We'll see ya.